Hello, guys. Good afternoon, good evening, or good morning, wherever you are listening from. This is my March 2026 market update and outlook. I have kind of consolidated a few of the themes that are going on in the market currently for the March month, and I wanted to just give you an update what has happened in March and whatever we're expecting to happen in the coming weeks or months. But we need to look at the overall March month and see how the market behaved. Okay, so I'm going to cover some of the most important uh, themes or factors that are involved in terms of some of the major changes that we have seen. Okay, so this topic is going to cover more about the overall media sentiment that we have covered, especially in the month of March. I'll cover some of the top headlines. We'll talk about 2026 YTD global um, index performance of across the globe, from Southeast Asia to South Asia to Europe and North America. How are the global indexes performing among itself? We talk about the S&P 500 correction that we have seen in the March month. Okay, the S&P 500 is more than 10% down overall. I wanted to talk about that, and we'll also look into the drawdowns, or the intra-year drawdowns and the total returns that we have seen in the past, and we'll compare that against what's happening in 2026. And we'll talk at the end about the multi-asset class returns versus the volatility factor. Now, this is in general looking at different multi-asset classes and trying to compare against each other and seeing how they perform against each other. Okay, so let's talk about the important aspect of the news that flowed into the month of March. A lot of um, obviously a lot of negativity and fear driven tone overall in the month of March, right? February we started to see drawdowns, or S&P kind of declining, started to decline by the end of February, and then throughout the month of March that we saw the continuous decline in the indexes. So and this has to be driven by the fact that we had a lot of geopolitical uncertainty, right? We have US-Israel conflict with Iran that began in February of 2028, that has escalated through March, right? With repeated references to the possible prolonged war rather than a brief flare-up. Okay, and that has resulted into media focusing on the Iran's closure of the Strait of Hormuz, threatening around close to 20% of the global oil supply and threatening worst-case stagflation narratives. And this is actually going on, and we are almost at the end of March, and we are thinking now, I think this is going to get escalated, and US is going to send its ground troop, and we will have a full-fledged war in our hands, and that is definitely going to rattle the commodities and the oil and the energy markets. The oil price spike reinforced the inflation and recession fears. We see the Brent crude surged close to 100 and $110 per barrel, reviving comparison to the 1970s energy shock and Russia-Ukraine 2022 crisis. So we have two ongoing wars right now. The Russia-Ukraine war has not been settled yet. Okay, and now we have this war coming up. So definitely this is going to create a huge uncertainty in what's going to happen in the energy sector. Okay, the headlines highlighted gas prices breaking close to $4 per gallon, which has already been the case, and we expect that this is going to go up to $5 to $6 per gallon easily in the coming weeks. We also see that there is the private credit stress becoming a secondary fear narrative. Bloomberg, CNBC, and Forbes reportedly gated redemptions and raising default risk in credit, especially in the private credit funds, through exposed SaaS softwares. Okay, and the terms like shadow banking risk and liquidation mismatch and 2008 parallel reappeared in headlines. So we saw a lot of negative headlines coming from the private credit market as well. And then we have the AI narrative that is getting shifted from euphoria to disruption anxiety. So these are like possibly like most of the important headlines that we have seen in the month of March. Not a good overall news flowing into the markets. Okay, and this has definitely rattled the overall market. And what we see, if you can look at this particular chart, it just shows you overall how the global indexes have performed against each other. The main theme over here is that if you look at S&P 500 and the MSCI emerging markets, they are down compared to the rest of the other indexes that you look at it from YTD standpoint. Okay. We'll talk about some of these other factors in terms of the correction that has taken place with S&P 500 in the past. So we'll go down to 2019. If you look at it, we had like major correction, not major correction, but very small correction of like 7 to 8% because of the trade tariffs, the inverted yield curve, global slowdown, recession fears, right, in 2019. And the major one that we saw was around negative 35% drawdown in 2020 because of the coronavirus and the global depression fears. Then we didn't see much happening. I think in 2021 we had a very fair bull market. We had smaller drawdowns, close to like 5 to 6% because of inflation fears, China's contagion fears, and Omicron variants, and Fed taper fears. So it wasn't a huge blow to the market, very small corrections. And then in 2022 we had a huge correction of 27%. That's because of the inflation, rising interest rate, Fed tightening, Russia-Ukraine war that started in 2022, right, and the recession fears. So that had around 27% of drawdown. And then in 2024 we had smaller corrections on the stubborn inflation, recession fears. And 2025, especially in the month of April, what happened with the Liberation Day phenomena of, again, tariffs and trade wars and global recession fears. Okay, that was close to negative 21% decline. But now we are in this drawdown phase, which is close to 7%. As of now, again, this is still ongoing because of the Iran war, crude oil spike, private credit turmoil, and AI disruption fear. So I feel like this hasn't been done yet. Means we see definitely a major more decline. I think this is definitely much bigger than the rest of the other ones that we talked about. So I think there's going to be a major decline coming in. So I remain bearish even in the month of April. I feel like there's a lot of uncertainty. As this Iran war escalates, I think we're going to see much more deeper drawdowns in the indexes as we go forward in the upcoming weeks. The other thing that we see on the drawdown and the total return side, this is just a plot that we show in terms of the intra-year drawdown, like in between some of the years that we saw a major decline. Mostly, the major decline that we have seen so far in the past like 15 years is probably the 2028 recession fears, and then 2020 the coronavirus. That's where you see the DD, which is basically the drawdown factor of close to like 30, more than 30%, but followed by a huge gain as well in some of the other year. The following year, if you see it, like 2021, we had a huge gain of close to 28.7%. And even in 2029, we saw the market rally of close to 26.5%. So, there's always going to be the drawdown in a particular year. And especially now we are in 2026, we see a bigger problem with the energy crisis. So we expect that the drawdown is going to be much bigger than what we are seeing right now currently, which is around 6.8%. And next, I think if you just look at this particular chart, this is just to showcase if you compare all of the multi-asset classes, in terms of looking at not just the equities, but also looking at bonds, high yields, preferred stocks, emerging markets, large cap growth, even Bitcoin. What we see is that the majority of the volatility is going to come from the growth sectors of United States, which is IWF, the QQQ, obviously from the Nasdaq, and also MDY which is your sorry, the MDY, the US mid cap. So most of the equities are going to give you higher returns. Means we have seen that higher returns of close to 15 to 20% if you look at it from like last 10 years perspective, with an annualized volatility much lower compared to VNQ and IWM. Okay. But you can see Bitcoin has been the exception here with the higher volatility and the higher returns. This is definitely the most riskiest asset you can be in. But most of the time, even if you look at QQQ and SPY, they are at a higher risk level. If you look at it from a volatility standpoint, much higher than if you look at CWB, HYG, EMB, LQD or TIPS or a bond, or even so those are possibly again the high yield bonds, the investable grade bonds. Those are actually definitely going to provide you lower returns, but their annualized volatility is much lower compared to the rest of the other growth and on the equity side. Okay, so this is kind of just a recap in terms of what we are seeing overall in the month of March. I'm going to cover more in detail some of the important factors that I feel is necessary to navigate through this market. There's a lot of headline news coming up, and it's actually increasing the volatility. Currently, the volatility factor has gone down, but it is hovering around 25 to 30 levels. So we'll cover more on that. We'll talk more about other asset classes and how the markets are behaving. See you then.